Welcome back to the show. Joining me now is Elisia Howard, and she is the founder and CEO of College Insights. It is a private college counseling company based out of the greater Seattle area, but works with families across the country. She has a master's in education, specializing in education policy, is a certified college counselor, and is the only certified financial aid advisor in Washington State. She has been in education for almost 20 years and has worked in college admissions for 10. What does that mean? Certified college counselors, well, they help students get into college. Certified financial aid advisors help students and families pay for college. These are two completely different areas of expertise, yet Elisia is equally strong in both, which is what separates her from all the other riffraff out there. She has been featured in a number of news outlets and podcasts and is frequently invited to speak at high schools, community organizations, and businesses throughout the U.S. And we asked her to come on our humble little podcast. Thanks for joining us today, Elisia.
Yes, thank you for having me today.
So we're going to talk about the student loan situation, and I got to say, this is an area that I haven't dug too much into. But I've talked to a few people that are struggling because they have the student loans, and there's been this kind of uncertainty over what's going on with forgiveness and that. So, which is probably why we're seeing it featured in the news. So how did it all get to this point?
Yes. So we talk about the student loan bubble, and the bubble burst. Like, it bursted 10 years ago, right? So that bursted a lot, is way gone. The reason it's in the news is because, well, those of us who are in the industry knew this was going to be a problem like 15 years ago. But finally, Congress and the Department of Education realized that there were some major holes in these policies. And a couple of years ago, when people went to apply for their forgiveness, 95% of the applications got rejected, which was a major problem, right? People were pretty mad about that, thinking they had followed the rules, and their student loan servicers just gave really bad advice. And there were holes to begin with. And so that is when we have two sides. So we have the Supreme Court, which is right now the Biden forgiveness, which is either the $10,000 or $20,000 in loans. That's being held up in the courts. There's some other stuff being held up in the courts as well. But the Department of Education, which is who services loans, basically, they have announced their own stuff that's going to be changing in July. And that really was just the holes that had to be filled, again, that I saw coming 15 years ago. And they finally announced, hey, yeah, we realized that there were issues when these policies came out. We're just going to fill the gaps that needed to be filled in the first place.
So, Elisia, I want to go back to the beginning of this, because you said it burst 10 years ago. What was the bubble and what burst in it? Because I got to say, I wasn't paying attention to higher education 10 years ago. So if you can kind of go back to that so I can better understand how it burst.
Yeah, I mean, it's been coming on for a very long time, but really when it started bursting, I would say 2008. Other academics would, debate with me on that, whatever, around that time. So what we had inflation was sitting around 3%, right, for the last, 30, 40 years, whatever it was. And the cost of college was going up by 6%. And that was happening for like 25 years. So college was doubling inflation for many, many, many years. And all of a sudden, right, 2008 hit and this recession hit. And you had all these people graduating from college who couldn't get jobs. And the cost of education by this point when you look at the charts from it back then, it's insane. Like, even from what my professors could pay, even adjusted for inflation to what we were paying, it was just astronomical. Like, there's no way a normal person could have paid for that. Right. And so people couldn't pay their loans. Right.
So essentially, if I can follow this, is what happened is the cost of tuition went up. The loans came along. People needed the schooling because they needed to be educated. When they finished their schooling, the job market fell apart. And then they're sitting there with a bunch of loans and a degree that doesn't get them the job that they need. And, that whole kind of challenge of now what do we do? And so now where we find ourselves is there's a couple of different programs, and The debt forgiveness one, I didn't hear about this one where 95 people got rejected, but that was a policy that these loan servicers put out there, said, hey, apply for this and we'll consider it. Is that what it was?
No. So back in, I want to say 2010. So the bubble burst, right? 2008,
Gotcha.
2009. And then they're like, oh, we should fix this because people don't have jobs and have to repay these loans. So that was under Obama, and they'd come out with these new types of repayment options. And they said, if you follow XYZ policies, you can apply for forgiveness down the road of your loans. And people didn't understand it back then because they weren't clear policies and they were changing a lot. And student loan servicers basically don't know what they're talking about ever. And so here it came when it was time to apply, and 95% of the applications got rejected. And for all kinds of dumb reasons that didn't make sense in the first place. But now there's an uproar, right? Because people were like, I did what you told me to do. I filed my taxes the way you told me to. I did my paperwork like I was told to. Like, why is this not getting forgiven? And that's where, the Department of Education was like, oh, there's problems in these policies that were very obvious 15 years ago, but they were like, we need to do something about that. And now those changes are in the process of happening. Basically.
So, and those are happening in July. And what are they?
So there's a few from the Department of Education standpoint. So they're closing some of the holes. For instance, a big one is that so forgiveness works over a period of time. It's by number of payments. And so they had a rule that if you consolidated your loan, you no longer got that forgiveness. So for example, I just had a client about a month ago who she already had 10 years worth of forgiveness. And so she would have qualified in within a few years in her situation, but she had consolidated back in November before talking to me, which means she lost 10 years towards her forgiveness.
Oh, wow.
Because that's what the student loan company told her to do. And really, you're like, that's dumb. Like, why does it matter it's the same lender? It's like it would be like switching from Wells Fargo and refinancing with Wells Fargo. Like, why would I lose all the payments I previously made?
And because of that consolidation, so she must have had a couple of student loans, and by putting them together into one, it terminated that pre-existing condition that she could have used.
Mm-hmm. Yeah, and it was a lot. In her case, it was like $50,000 of forgiveness she lost.
So with these new changes, and being that you're in your position, I mean, we've talked about students getting into college, but this is for individuals that have completed college, are in the workforce, and are struggling, to get these things paid off. And one of the things I didn't mention while we were talking with Tucker is they have to consider your monthly payments to student loans, and that is against your debt to income ratio, which means you would qualify for less if you have a monthly payment for these student loans. So first off, in order for somebody to qualify for a loan, you have to be in good standing, right? So there's that. But is there a way to help mitigate their challenges and then still be able to take advantage of the credit out there for buying a home?
Yes. So I get this a lot from people. So one of the policy changes they're going to be making in July as well is that the people who had older loans when these new policies came into effect. So think of people who graduated like 80s, 90s, early 2000s, right? Who hadn't paid their loans off yet. They're going to do an automatic, I don't want to say wipeout because there is paperwork involved, but basically if you have loans that are old, right? Like they're 20 years old and you've been paying on them, those get to go away now in July. And so a lot of people who, maybe couldn't have qualified or are homeowners, but they want to get a better house or these kinds of things. Now those loans, like I was just talking to a friend of mine the other day who has like $60,000 left from law school, but like in a couple of years, that $60,000 is going to go away. And so now that falls off of his debt to income ratio, right? And now he can qualify for more of a mortgage.
Do you think it will show up as a bad credit hit?
Nope, it's not like a bankruptcy. It's not negative. It's just it's a forgiveness. So it basically will show that it was paid in full, really, on your credit.
Okay. So for people who are unsure what to do next, what do you recommend? And this, again, we're talking about people that have completed school that have outstanding student loans.
Yes. So I would say call me. But the big thing is if you have to be very careful in what paperwork you're doing. The situation is very complicated and how the policies have been written, because unfortunately there's this gap between paperwork has to be filed by May 1st, but the official policies and how they're going to be implemented don't happen till July. So we're having to make decisions without complete information. But it took me and a student loan attorney over 2 hours to sift through all the Department of Education paperwork and policies, and a lot of them were conflicting. And I was like, if it takes me and a student loan attorney 2 hours to figure this out,
right?
like, how is the average person going to know what to do? I mean, even I was sitting there like, oh my gosh, what am I supposed to do over here? So the big one, though, is for people with older loans. Generally, they're old, like FEL loans, which is a different type of loan. Those need to be consolidated before May 1st, because
You said not to consolidate loans.
Now they're changing it, though. In July, they're not going to count that anymore. And so if you have old loans and they need to be direct loans to be forgiven, you need to consolidate them, because they're going to do a one-time adjustment. So they're going to do that in July. So they're going to do a one-time adjustment. So if you're one of these people with, 10 years, 15 years on your loans, and you consolidate them, now it doesn't hurt you anymore. That's not going to hurt you. So you got to do it before May 1st. Then in July, when they do all these recounts and stuff, they're going to count those payments that you've been making all this time.
I see. So if you were to guess on what the Supreme Court does with the Biden stuff, what would they do? What do you think?
I say it's 50-50 at this point.
Yeah.
I could speculate, but there's so many political things involved in that. And so I'm telling people, like, don't count on that. And honestly, it can hurt you. It's actually easier to get larger debt forgiven than smaller debt forgiven. So there's some people, we run the numbers and I'm like, it didn't even make sense for you to apply for that. Like, you would have gotten more forgiven if you didn't get that forgiveness. Yeah. So.
Well, and, as I think about kind of the future landscape for schools, I remember hearing them talking about increases in tuition at the University of Washington and all that stuff. And I'm putting 2 kids through school right now, and we're very price conscious, right? Mm-hmm. And I did have to take out some student loans, but not many. And I really, essentially I'm backing my kids' loans, but there's a lot of options out there for schools that don't cost an arm and a leg. And that's I would say that's one of the reasons for sitting down with somebody like yourself, is because you're going to be able to sit down and find out about the children and what their goals and objectives are, and help them find a match for the parent's income and for the child's needs.
Yeah, and I would say the big thing that's happening, which I think will be big for mortgage qualifications as well, is that their Department of Education is going to place some sort of cap on how much interest can accrue, because like when you have a mortgage, you're paying your monthly mortgage, and yes, at first most of that money goes towards interest, but over time it starts going towards principal, right? And you pay it down.
Right.
Student loans don't work that way. So this happens all the time. And I think this is one of the biggest myths. And it's an easy way to tick me off, is when people are like, oh, these millennials don't want to pay off their loans. They're so lazy. Right. And I'm like, you don't understand. It doesn't work the same way. And so I just had a client the other day, took out $30,000 for college. This was I don't know, a long time ago. Has paid over $60,000 on her loans. Okay. Yeah. Guess how much she still owes? $147,000.
How does that work? Compound interest?
Student loans, that's how they work. It's insane. And so you'll have people paying and paying and paying.
Wait, because she's paying some kind of, I assume she is a him or her, they or them, are because they're paying less than the actual principal and interest or something like that, or how the loan is structured. Pay her $350 a month and she's going backwards.
Yeah, or people pay and like, all it takes is a recession and a couple years they couldn't pay, so they were in forbearance and interest was accruing. And like, I mean, I can't even tell you how many times I've seen people, and you look at the original, like I was just looking, so my student loans are about to be forgiven because I was on top of this many years ago, hence how I got into this industry. But I just got the statement yesterday from my servicer, and it was going to start at like 70,000, and if I paid it off in 10 years, my interest, only the interest, not the principal, the interest was $100,000. So I would have had to pay $197,000 total in 10 years to pay off what was $70,000 in original loans. Insane. Right? It's crazy. And so they're going to cap that so that future generations don't have to deal with it. But that's one of the reasons they're making these adjustments and these kind of auto forgiveness of people with older loans, because most people with older loans actually have more than double paid their loans off. They just keep accruing this interest.
Isn't there like a standard interest rate that's kind of capped?
It depends what kind of loan and when you have, but the student loan interest rate is now tied to the federal interest rate. That was supposed to be a temporary fix because at the time interest rates were incredibly low when that was passed. But then when interest rates went up, people's student loan interest rates went up, and that kind of created a problem.
That kind of stuff. So, well, this is a tremendously interesting conversation, and it does relate, because there are people who are in a spot where they cannot buy a home because of their student loan debt. And I think it's, like I said, on the front end, if you're heading into college, definitely would reach out to Elisia. If you're, sitting there going, what should I do? Reach out as well. It looks like the sun went down on where you're at.
Probably.
The light just went away. I was like,
I'm not in Mexico anymore. I was in Mexico. And now I'm like, oh, where my son went away. One thing I was going to mention, though, one of the changes they made or going to be making in July is they're going to change one of the payment plans that will be huge, especially for my clients that are like doctors, lawyers. They have large student loans. So they're going to basically cut that in half to make it easy to understand. So if you are like one of my chiropractors I get all the time, and you have a $3,000 a month payment, that will, now we can put you in programs where it's going to be $1,500 a month. And we use that kind of strategy all the time for people who want to buy homes, because now, we do that for a year or two, and now we can save enough to put more of a down payment down. Right. And now you can qualify more for a home that you want, or other things, right? Retirement, whatever your financial goals are. But if we can save $1,500 a month or whatever, that's a lot of money to be able to put towards a house.
Yeah. Awesome. Well, thanks. You guys can see the phone number going across the board there, 425-507-9069. Is there any other way they can do some research on you?
Yeah, they can go to www.collegeinsights.com, and you can check out the website, and our email and phone number and stuff is on there. And you can there's a little form you can even fill out and click the little student loan button and schedule a consultation.
All right. Well, thank you for coming on, Elisia. I appreciate it.
Yes, thank you for having me.
Yeah.